Hello everyone. Today, let's discuss the core drivers and potential risks of the U.S. stock market's bull run. Over the past 2 years, the U.S. stock market has experienced a bull run of epic proportions. While market sentiment is high, the S&P 500's performance is not uniformly shared. Its structure reveals extreme concentration. The data doesn't lie. Over the past year, traditionally safe and conservative sectors like consumer staples, real estate, healthcare, and traditional energy have underperformed the broader market by over 20%. This means that virtually all of the market's growth and optimism has been concentrated in the technology sector, particularly companies investing heavily in artificial intelligence. It's no exaggeration to say that today's U.S. stock market is an AI-driven extravaganza. Without AI, there would be no U.S. stock market bull market. Therefore, the key question remains, what is the payback ratio for this massive AI gamble, fueled by trillions of dollars in investment? Can it truly sustain the U.S. stock market's bull run? Or is it destined to collapse like many other major bubbles in history? To understand the importance of AI to the U.S. stock market, we must first acknowledge its massive investment in the real economy. This is an unprecedented new infrastructure campaign, the scale of which is sufficient to have a significant impact on the U.S. economy, which is worth $30 trillion. The Wall Street Journal made a striking comparison. Over the past 3 years, tech companies have invested more in data centers, chips, and electricity, adjusted for inflation, than the U.S. spent on building the entire interstate highway system over the past 4 decades. This money is pouring into AI infrastructure at an unprecedented rate, and a handful of tech giants are the protagonists of this AI arms race. According to the latest analysis, global AI-related capital expenditures are expected to surge 67% in 2025 to $375 billion, and increase further by 33% in 2026 to $500 billion. The capital expenditure plans of these giants are as follows. Amazon plans to invest over $100 billion in AI within AWS, Amazon Web Services, in 2025, focusing on data centers and customized AI training chips. Amazon's trailing 12-month free cash flow reached $18.2 billion in the second quarter of 2025, demonstrating its ability to make such large-scale investments. Microsoft allocated approximately $80 billion for global AI infrastructure development in fiscal year 2025. As of March 31, 2025, Microsoft had nearly $80 billion in cash and short-term investments, demonstrating its strong capital position. Google's parent company, Alphabet, increased its 2025 capital expenditure budget from an initial $75 billion to $85 billion, primarily for AI data centers and hardware. With $95 billion in cash and marketable securities, Google also possesses a strong financial foundation. Meta projects its capital expenditures in 2025 to be between $66 billion and $72 billion, with a similarly significant increase expected in 2026 to meet AI demands. Meta also held over $47 billion in cash equivalents, and marketable securities as of the end of June 2025. This massive amount of capital is not just for purchasing expensive chips. It is primarily an investment in the physical new infrastructure. Every AI data center costing over $1 billion requires vast amounts of land, electricity, building materials, and cooling systems. This hunger for electricity is forcing the modernization of the U.S. power grid. A report by the International Energy Agency, IEA, indicates that by 2030, AI-driven data center electricity consumption could account for nearly half of the country's new electricity demand. To meet this exploding demand, U.S. private utilities will invest over $1.1 trillion in expanding and modernizing grid infrastructure between 2025 and 2029 alone. This massive capital expenditure has a powerful multiplier effect, not a linear one. The American Society of Civil Engineers, ASCE, estimates that every $1 billion invested in infrastructure creates 13,000 jobs and generates $3 billion in GDP growth over a decade. This effect is already evident. By the second quarter of 2025, AI-related capital expenditures had already contributed over a third of U.S. real GDP growth, or approximately 0.4 percentage points. Therefore, investment in AI has undoubtedly become a powerful engine of U.S. economic growth in the short term. While the scale of investment is staggering, the core question of this gamble is whether the economic returns (ROI) from these massive investments have materialized enough to sustain the AI investment output game. This AI craze is reminiscent of the telecommunications boom of the late 1990s. Back then, companies invested heavily in laying fiber optic networks. Although connectivity itself was disruptive, overinvestment and a lack of demand to justify the costs ultimately led to the bankruptcy of giants like Global Crossing and WorldCom. The internet was transformative, but from a return on investment (ROI) perspective at the time, it was a disaster. Let's listen to venture capitalist and Sequoia Capital partner David Kahn's calculations on current investments. He estimates that investments in AI infrastructure in 2023 and 2024 alone will require consumers and businesses to purchase approximately $800 billion in AI products over the lifecycle of these chips and data centers, typically only 3 to 5 years, to generate a reasonable return on investment. However, current actual output figures fall far short of this target. Current revenue. Morgan Stanley estimates that total AI product revenue will be only approximately $45 billion in 2024. Valuation bubble. Consulting firm Bain & Company estimates that annual AI revenue of up to $2 trillion will be needed by 2030 to justify the current wave of infrastructure spending. This figure is greater than the combined 2024 revenue of the 6 largest tech giants: Amazon, Apple, Google, Microsoft, Meta, and Nvidia. This yawning gap between input and output is reminiscent of some of China's major infrastructure projects, such as high-speed rail and subway networks. These projects contribute significantly to GDP during their construction period and hold strategic significance for regional integration and efficiency improvements, but their operational sustainability lacks economic viability. Research shows that only approximately 6% to 30% of China's high-speed rail lines are profitable, while the majority suffer chronic losses and require substantial subsidies to maintain operation. China's subway system is also burdened with enormous construction debt, forcing some cities to reduce service frequency and dim lights to save operating costs. AI's new infrastructure faces a similar operational curse. Some analysts suggest that newly built AI data centers by 2025 will incur annual depreciation of up to $40 billion, while potentially generating only $15 billion to $20 billion in revenue. This means that AI infrastructure itself is currently losing money, which is why hedge fund manager David Einhorn has warned of massive capital destruction. Faced with this massive imbalance between input and output, investors face a stark choice. Market analysts point out that in this extremely overbought market and deviations from the long-term mean, exiting too early can be costly, while staying in too long could lead to a brutal liquidation. Investors are walking a tightrope, requiring careful consideration at every step. Since AI infrastructure is currently losing money, how can this race be sustained? The answer lies in a fundamental difference between today's AI gamble and the dot-com bubble of 2000, the capital base. In 2000, many bankrupt dot-com companies relied entirely on venture capital and high-risk debt to stay afloat. Today's Big 7 AI companies are different. They possess unrivaled capital-generating capabilities and healthy balance sheets in their core businesses: cloud services, advertising, and e-commerce. This race isn't driven by high-risk debt, but rather by these giants' own robust profits. For example, companies like Microsoft and Google sit on tens of billions of dollars in cash reserves, allowing them to withstand the gap between AI investment and output for a long time, waiting for the technology and market to truly mature. Thus, even if the so-called AI bubble bursts, it will more likely be a return of value within the tech industry. These well-funded giants have ample capital and time to hold on, and can even acquire the technology and talent of outdated AI startups at bargain prices when the bubble bursts. If it takes a long enough time to resolve the imbalance between investment and output in the AI industry, is this realistic? In other words, does AI have the capacity to increase productivity to the level expected by the market? That's all for today. We'll continue next time.